Hello everybody and welcome back. In this video I want to make a quick update on earnings season because we are in the middle of the earnings season, almost at the end, and almost all my companies reported. So in this video I want to talk about my performance, talk about the companies I monitor and the companies I have in my portfolio because the majority of them reported earnings, and I want to go through all of them to see the green flags, red flags, what is happening right now. So share a little bit the behind the scenes, as we say, how you manage your portfolio, what are the moves I've done, because I bought some things, I sold some things, and you will understand my strategy, how I plan to continue to outperform the market. In case this is your first video from this channel, welcome. My name is Christophe Nour. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I'm on track right now to reach my goal. If I make 21% this year, I will still keep my CAGR of 25% per year. So another year, as we say. Now the performance so far year to date, as I'm recording today, is 20.45%. If you compare this to the S&P 500, today we are at a year to date performance of 14.5%. So that's a 6% alpha here, 6% outperformance. I'm very happy. I don't want more than this. That's fine to me. 20% per year, it's more than enough. So really happy with the performance year to date, and I plan to continue. If you look at the holdings of my portfolio, things have changed. I don't know for you guys if you have bought some things, sold some things, but I made a video before the earnings season about what I was monitoring. And it turns out that all the companies in my portfolio performed really good. This is also the reason I am making 25% per year. I built this portfolio of high quality companies so that I can sleep well at night, because I know that these companies will perform very well. The operations will be very well, up and to the right. More revenue, more margins, more net income, more free cash flow, more return on invested capital, more buybacks. And this is how I plan to continue to invest. A couple of days ago, I made a video, and how can I say it? The mindset of the portfolio has changed. You have a shift in my investment strategy. Last year, I had some value plays, and now I want to increase the quality of my holdings. And I want the holdings, the companies, to be like this. I want to spot the same pattern. I want the revenue CAGR, compound annual growth rate, so the revenue growth rate, to be inferior to the gross profit growth rate, to be inferior to the EBIT growth rate, EBIT operating income, right? To be inferior to the net income growth rate, to be inferior to the earnings per share growth rate. Okay? If this is good for a company, that means I can buy this company. And I want all my companies to have this pattern. What it means is you have your revenue growth rate of, 8%. Your gross profits are growing at a better rate than 8%, like 10%, for example, because you have better margins. After this, your EBIT growth rate is better than 10%, let's say 12%, which means better operating margins. After this, the net income is getting better. So interest and taxes may be improving a little bit from 12 to 13% growth rate. Add to this a little bit of buybacks, and you have a nice earnings per share growth rate of 15% per year. And I've made a decision a few weeks ago, months ago, to really change the portfolio and to only focus on this pattern. And strangely enough, I don't see many super investors following this pattern. Either I'm the only one, or I'm just stupid and I just don't know these people, but I've done some heavy research and I've seen zero people having this strategy of efficiency, better margins, better capital allocation decisions, and buybacks. Okay, if you have one name in mind, please, the comment section below is is made for these kind of interactions. So if you know one public investor doing this, please let me know. But yeah, I've seen nobody do this strategy of revenue growth, efficiency, margins, return on capital, buybacks, which leads to an earnings per share growth rate of 15% per year. Okay? By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. And I made some cleaning in my portfolio, and here is what we have. The only big company in my portfolio that didn't report earnings is Brookfield. Well, I don't worry much about Brookfield. That's my biggest position. Normally, when they report earnings, the stock is moving 2 or 3% up or down. I don't care much. It's a buy and hold, sleep well at night investment, okay? For Google here, Google has become the second largest position in my portfolio because it has gone up so much. It has gone up so much. The stock is 50% up year to date. The sentiment for Google has changed meaningfully. Now people are praising Google, praising the CEO, saying that Google is a clear leader. It's very funny how weak people are. The mind is changing a lot. The opinions are changing a lot. People have no conviction in this market. I don't know if you have a lot of beginners in this market. People have literally zero conviction. People were freaking out a couple of months ago when the stock price was $140. And now it has doubled and people are cheering up. People are very happy, a lot of tailwinds, etc. Yep, the sentiment is very weak. It can go back down again. So very happy with the performance of Google. It's also the reason why I am outperforming this market. It's because I invest in companies with a clear tailwind, and the valuation was very cheap a couple of months ago. The earnings were pretty good, pretty decent, and now the valuation has gotten expensive, I would say. Either fairly priced or expensive. Next question, will I sell Google now that we have this re-rating? No, it's a buy and hold. Maybe I will trim by 1%, 2%, but I will keep it at a core holding, right? Maybe if, I don't know, Fortinet drops or MSCI drops, maybe I will sell 1 or 2% to buy the other things that are cheaper. But for the moment, I don't plan to change Google, right? Next one on the list, you have Autozone. They did not report earnings yet, but already reported earnings. So I see them as twins. So it's very similar. The story has not changed for Autozone. The story has not changed in a while. The stock is 13% up to date. You have no meaningful change for Autozone. The strategy is the same. More revenue, more growth, more locations, international expansion. It's a buy and hold and you do nothing and you sleep. So Autozone will report earnings in a few days. It's fine to me, okay? Here, this is a very interesting story. The fourth biggest holding I have in my portfolio, 10% of my portfolio, is Lam Research. It was not the case when I bought. When I bought the stock, it was an allocation of roughly 7%. And it has gone up so much in value that now it's a core holding. Now it's a very big holding in my portfolio and one of the best companies if you want to invest in AI. They are in a clear intersection, a golden sweet spot, and they are printing cash right now. Next year is supposed to be a reinvestment year. They upgraded their guidance. They plan to be fairly stable next year. So they improve the guidance, they improve the margins, they improve the buybacks, they improve the cash flows, they improve the net income, they improve the guidance, they improve next year, they improve the moat over time. You have many things happening at the same time. And I remember when I bought at $80, people were not very happy with this investment. Now it's a double and people say it's too late. We will see. Time will tell. When I bought Lam Research, they had a PE ratio of 17. It was a leader in its category, an efficiency beast. I posted a video a couple of weeks ago about Lam Research. They went from a revenue growth rate of 13%. Oh, sorry for the bad writing. 13% revenue growth rate to an earnings per share of more than 25%. Boom. And in the very long term, stock prices follow earnings per share. If you can invest in companies that can grow earnings per share at 25% per year, eventually, in the very long term, their stock prices will go up at 25% per year. And this is the reason why I am making 25% per year, because I spot these opportunities to make 20% per year. So you want these efficiency beasts. You want companies that can grow earnings per share at 20, 25, 30% per year. Lam Research is one example. And at the same time, you had a re-rating from a PE ratio of 17 to 20 to 25, 30. So yeah, it's a quick run-up here, quick re-rating because the growth rate is accelerating. Beautiful story. I don't plan to sell Lam Research. And the earnings were just phenomenal. Now for another holding, this is very recent, Fortinet, that is now 10% of my portfolio. I'm very happy with my new buy of Fortinet. Before this earnings season, I had Amazon as a key holding. It was like 10% of my portfolio. I sold half of Amazon. Amazon is now 5% of my portfolio. And I doubled down on Fortinet. I've been saying for weeks, I want to buy Fortinet, but I want the stock price to drop. I've been on podcasts on other YouTubers' channels saying I want to buy more Fortinet, but because of the valuation, I need more discipline. And I was very lucky because the price dropped after earnings. Fortinet, I made a video about this a couple of days ago. Fortinet had very good earnings, and people don't understand this company because you have a couple of accounting changes, and it was a misunderstood earnings report, and I love to take advantage of these opportunities. Okay, this is another reason why I'm outperforming the market for so many years. I mean, it's almost a decade now, because sometimes you have opportunities where people are panicking. Well, you seize your opportunity, you double your position, very happy with the performance, and if Fortinet drops more, I'm happy to buy more. I'm happy to liquidate my Amazon position to buy more Fortinet. Okay, now on the list, you have Meta Platforms. Meta Platforms is dropping right now because people are not happy with the investments they are making. People say that Mark Zuckerberg is investing too much in AI, the same way he invested too much in the metaverse. People, it's quite funny actually. It's either shocking or funny. You do whatever you want. Every time the stock drops, people doubt Mark Zuckerberg. Every time people doubt Mark Zuckerberg, they are proven wrong. It's been more than 10 years now, more than 15 years. But every time the stock drops, people are worried and are doubting Mark Zuckerberg. And when the stock was at all-time highs this summer, people said, never doubt Mark Zuckerberg. He's the genius. He's wonderful. Meta Platform is a clear AI leader. And now the stock is dropping 20%. And I see people on Twitter, on YouTube saying, Mark is investing too much. Again, people are doubting Mark Zuckerberg. People don't learn from history. Sometimes you have like big investors saying that history doesn't repeat, but it rhymes. It's very true. People forget too much, too easily. And every time the stock dropped, it was a good opportunity to accumulate more shares. Do you think Meta Platforms will be here in 5 years? Do you think they will have more users in 5 years? Do you think they will have more revenue in 5 years? Yes, yes, yes. This is my opinion. This is why I'm buying. And this is why I'm holding Meta Platforms. I'm not panic selling because of this report. But yeah, for weak people, weak hands, paper hands, as we say, the stock price is dropping 20%. This is very funny. And on the year-to-date performance, we are up 3%. It's very funny how tables turn. Before it was Google that was the loser, Amazon that was the loser, and Meta Platforms was the clear leader a couple of months ago. And now Amazon is up year-to-date, more than 10%. Google is up by 50%, and Meta is flat. Very funny. That's part of investing in the stock market. Sometimes stocks go up, sometimes stocks go down. But the report from Meta Platforms was okay. Completely okay. Maybe they will invest too much, but it's all about revenue growth. So no worries whatsoever. They had to pay a huge tax for this quarter, which is the reason why the stock is down also. The net income is down. They had a tax rate of 80% this quarter. So yes, of course, the PE ratio means nothing for the stock right now, because PE ratio means price earnings. Because of the high tax rate, the earnings are lower. So the PE ratio will skyrocket. You can check some financial websites. They will show you a PE ratio of 80. It's not true. You have to adjust for this tax rate. So yeah, I would say now is a pretty good moment to accumulate more Meta Platforms shares. If you want to buy Meta Platforms, when do you buy? If not now. This is not financial advice. You do whatever you want with your capital. But if you were on the sidelines for many months and you were kicking yourself because you didn't buy it in April, maybe time is now. Maybe this is a good time to accumulate more shares. I have already 9-10% of my portfolio in Meta Platform, so I will not buy more shares. But the report was pretty good. It's one of the clear leaders. Another one that reported earnings, 9% of my portfolio, is Mastercard. Mastercard is a boring play. I will not make a video about Mastercard because nothing ever happens for Mastercard. The stock is not moving that much. The performance is stellar. The revenue is going up by 17%. The net income is up double digits. Earnings per share double digits. They do buybacks every year. Nothing ever happens for Visa and Mastercard. They are just marching forward, increasing revenue, increasing efficiency, increasing margins, and the forward PE ratio is 29. I would say another one, Mastercard, is maybe a good buy right now. I will not buy more shares. I have 9% of my portfolio. This is a defensive play, but the report was great. And now, because the stock has done nothing this year, plus 6% year to date, and earnings have gone up, you have a re-rating. So the valuation came down. Now is a reasonable moment to buy Mastercard, actually. We are at fair value, an extremely good business at fair value. It will not make you 30% per year, but it's a defensive play that you don't have to monitor, right? And I bought Mastercard exactly for this reason. In case you have a crash like 2022, you have a bear market, I know I will not spend 1 minute of my time analyzing Mastercard, monitoring Mastercard, because I know the business will be safe, especially in a world with inflation. Mastercard is a very good hedge against inflation. The companies you want to monitor when there is a crash are tech companies that are investing a lot in AI. What if AI is a bubble and everything falls? Well, you have to check the capex, the margins, the mindset of the business model. Are they pivoting or not? Same thing for Lam Research. I mean, weaker businesses, recent young businesses, you want to spend more time analyzing them. I bought Mastercard to not spend 1 minute of my time monitoring it like a child, right? It's a defensive play. And when you have a bear market, when you have markets that are down, I will just let it go and do whatever it wants. I don't have to monitor. It's a defensive play. And when markets go down, Mastercard goes down less than the market. So when markets go up, Mastercard goes at the same level at the market. But when markets go down, Mastercard drops less. So it's a good inflation hedge and it's a good defensive play. Next one on the list, something that I've been accumulating this year is MSCI. I made a 3-hour-long video 1 week ago about MSCI. The video was complete, a little bit too long. I don't think I will do 3 hours long videos again. But yeah, that's a little bit too long for most people, 3 hours. So the business is fine. The valuation is now reasonable. And they are doing their biggest buyback program ever. The management team for MSCI, same thing for Fortinet, by the way, they are literally telling us investors they are undervalued and they are doing their biggest buyback ever. MSCI just raised more debt to do more buybacks. And yeah, pretty bullish. They bought back 3% of their shares with more debt. The operations are still fine. The earnings per share are growing roughly 15%. Things are very healthy for MSCI. And I believe MSCI is a very good inflation hedge. The earnings report was extremely bullish in my opinion. You have an exemplary business model with an exemplary management team available at a fair price. I'm buying more. Next one on the list, you go into the lower conviction plays, because in terms of allocation, you go below 7%. 6% of the portfolio is Landbridge. They report earnings in 1 week. It's a speculative play, right? Either it can 10x or it can go to 0. But I like the odds so far. Landbridge is a company I know very well because I've been following TPL for many, many years. They own lands in Texas and they are aggressive. The management team needs to be very efficient. It's a young company. They IPO'd last year, and I bought after the IPO, and I'm monitoring the story. And there is a chance where they welcome data centers on their lands. And if this is the case, the stock will go up immensely, more than $100 per share. So you have a very aggressive management team. You had a short report on Landbridge. People don't like Landbridge. You have a lot of hate and a lot of love at the same time. And I'm in the middle of it, investing a small amount of my portfolio as a speculative bet. In case it works out, it's a 10x. In case it's a mistake, it's only 5-6% of my portfolio. So it will not kill me. Okay, but I like the odds right now. I will make a video when they report earnings, don't worry guys. But yeah, very interesting story. You definitely want to spend more time analyzing Landbridge in my opinion. Mastercard, you don't want to spend any time, 0 minutes spent about Mastercard. But for Landbridge, you want to spend hours checking what the management does, checking what the management says, checking if they walk the talk, checking what are the growth opportunities, cross-reading what TPL is saying or what other energy players are saying. But yeah, very interesting story. It's a lot of work, but it's a lot of reward if it works out okay, right? And if the stock goes up immensely, I will let it run. I will not trim, I think. I'm okay if it goes to 10% of my portfolio in a couple of months. Okay, next one on the list, you have Amazon. This is the #1 company I want to sell in my portfolio. Okay, I don't make a lot of videos about stocks I want to sell. I made videos about my sales in the past. Amazon is a company I want to sell in the future because I've thought about it a lot. It's a clear leader in AI, AWS, growth rate, I know. But it's about this pattern, right? If I want to build a portfolio with this pattern, I want efficiency beasts. And the big capex ramp up, the lower margins, the capital intensiveness of Amazon doesn't fit this pattern. And what is great is I see other opportunities in this market that fit this pattern. I can name 2, Fortinet, MSCI. So if Fortinet and MSCI are dropping, I will sell the remaining Amazon to buy more Fortinet and MSCI. I'm very happy to put Fortinet at 12% position, so I can buy 2% more. I'm very happy to put MSCI as a core holding like 10, 11%. So I have 5 or 6% that I can allocate towards these 2 companies, right? But I want to sell Amazon. I want the stock to go as high as possible, and I want MSCI to continue to drop so I can accumulate more shares. But we will see at the end of the year. Now we are in November. You have this catch-up effect. Fund managers want to outperform, and fund managers that are lagging the market will have to sell losers to buy winners. Every year you have this at the end of the year. You have this catch-up effect. So maybe things that have worked this year, like Google, will go up. And now the trend is reversing for Amazon. The sentiment is shifting. So people are becoming positive on Amazon, which means it's not a 50-50% odd that Amazon goes up until the end of the year. It's 60%, 40%. I'm not 100% sure, of course. But yeah, maybe because now the sentiment is changing for Amazon, the stock will go up immensely. If it goes up, I'm happy to hold, and I want my other holdings to go down in value. So I will sell at a profit for Amazon. But I'm in the green for this one, so no worries at all. And then you have these 2 small value plays that I have in my portfolio. AMR, they just reported earnings. The earnings are fine. It's a company in the coal market, not sexy at all, right? Coal market, met coal market, and this industry is cyclical. And now they don't have any profits whatsoever, but they don't have debt. So they are in a safe position. What if the cycle turns again? Well, if the cycle turns, they will print cash and they will do a lot of buybacks. They reported earnings, and actually 1 hour before shooting this video, I was listening to the call. I checked the report. The report is fine. I don't know if I will make a video about this. You don't have a lot of things to say about this report, actually. The management team in the last quarter, so second quarter of 2025, they explicitly called the bottom for the industry. No other YouTuber mentioned this. They explicitly said, we have our cash balance. We've been sustaining our cash balance for many quarters in a row, and we have stopped the buybacks many quarters in a row. Now we are very comfortable to use this cash to do buybacks again, to start buybacks again. At the same time, they reduce the guidance for cost. So it seems like it is starting to improve, and we can feel the bottom a little bit for Alpha Metallurgical Resources. For all the met coal companies, same thing. So maybe things are turning. I am not 100% sure, but I'm still holding. This is everything you want to remember, right? I'm not selling, I'm not buying more, I'm just holding and seeing where it goes. Because since the second quarter of 2025, well, the stock went up immensely from $100 to $170. What if it goes up? What if it continues to go up? What if we have a clear reversal? If we have a clear reversal and the price of met coal goes up immensely, I would not be surprised if the stock reaches $300 next year. So it's a potential double, and the management is clearly telling you we have early signs of a reversal of the cyclicality. So they are seeing the bottom, and actually this quarter, like 1 hour ago, I checked the earnings report, and they are continuing to decrease the guidance for cost. They are expecting less cost. So you have a lot of financial flexibility. And they did some buybacks. They started buybacks again. Maybe I can show you what I mean. AMR. It's a good value play. I mean, if you want a value play right now, I would say it's very good. Crocs is very, very nice. If you want value plays, Crocs is maybe the best one. I made a video on my YouTube channel about Crocs if you want. And AMR also is a very good, common shares, buybacks, is a very good value play quarterly. Okay, wonderful. So you see plenty of buybacks here in 2022, 2023, and they have stopped. They have stopped the buybacks, and now they are doing buybacks again. Let me show you this so you understand better. Look at this. In blue, that's the cash from operating activities for this coal company. In green, that's the buybacks. You see that they did some buybacks in the past. And now 1, 2, 3, 4, 5 quarters of zero buybacks. And now after 6 quarters, they are starting again, ramping up the buybacks. Maybe they will continue. Maybe the buybacks will accelerate. Nobody knows. You don't know. I don't know. Nobody knows if it will accelerate. But apparently the management is sustaining cash. Even if you have a down market, cyclically adjusted, down market, they are not losing cash flows. They are not having debt. So this is a safe investment for them. They are in a safe position of not having any debt, and they don't have losses, which is fine. So yeah, it's a good reversal, and it can double from there. And the last one is Gravity. It's 1% of my portfolio. It will not move a lot. It's just foot in the door strategy to follow the Korean market. And at the same time, this is a company that is trading at cash. Gravity is a company in Korea. They create mobile games. And I've played their games. I know them. And now they are trading at cash. The market cap is $400 million, and they have $400 million of cash on their balance sheet. So you have a company for free. They have very good support at cash level. I made videos on my channel about Gravity if you want more information. I think it's very safe. In terms of risk reward, it can't go down. Gravity just can't go down. So in case you have a crash in this market, Gravity will not go down. It's only upside. So the downside, 0. The upside, 20%, 30%. As you accumulate more cash, you will go directly to the balance sheet, so the support level will increase. So yeah, it's a matter of risk reward here. It's not something that will help me make 20% per year, but it's a defensive play. And if the stock drops below cash level, I'm a happy buyer. Okay, so this was for the update. Most of the companies have reported earnings. Most of the companies have had good earnings, which is very good. And it allowed me to increase my outperformance to the overall index. And I'm very happy because I survived. And this is maybe the most important thing. And I want to end with this. If you are watching your portfolio right now, maybe some of your stocks are getting killed. I won't name names, but I think you know what I'm talking about. Some popular names got killed during this earnings season. And the goal with this portfolio is to get quality companies that are not getting killed, right? You don't want 50% losses that are destroying your outperformance. And I made some twists along the way, some changes in this portfolio in 2025 to reduce the likelihood of getting killed, to increase the quality of the portfolio so you have much more chances of generating good reports, boring reports, but increasing reports, increasing revenues, increasing net income, increasing free cash flow, increasing buybacks, margin, etc., etc. And I plan to do the same for next year, to continue to increase the quality of my holdings so I can continue to make 25% per year. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.